Welcome to the Gray Report. I'm your host, Spencer Gray, and every single week on the Gray Report, we're breaking down all the latest research reports, articles, and we're throwing out some original opinions on the multifamily industry, commercial real estate, and also the macro economy. Griffin Haddad is here once again, co-hosting the Gray Report, and we're doing something special. If you're watching right now, we're doing a live episode, having some fun, getting a little more practice doing this live. And the format's going to be pretty similar, but a little bit different also. We're going to be going over some new articles. Apartments.com has a piece over 11 factors that are going to be shaping the multifamily industry in 2026. I was going to be giving another little tease for our latest research report, the 2026 Midwest Multifamily Forecast, which you can download on our website, graycapitalllc.com. And if you do that, you can sign up for the webinar that we're having on December 16th that you're not going to want to miss. But then after that, we're going to be spilling a lot of the secrets of Gray Capital and how we raise capital for multifamily investments from all kinds of different investors. Because Griffin and I, we just got back last night, this morning actually, from an investment conference down in Miami, Florida. We do these throughout the year, and we don't talk about it that much. But we thought it'd be interesting to kind of give a breakdown of what these type of conferences are like. And maybe you go to these a lot in your experience, but I think a lot of folks who haven't, kind of been involved in the kind of the capital raising environment, kind of trying to raise institutional capital, because that's what these conferences that we go to are typically focused on, is more institutional capital, family offices, pension funds, endowments, family stuff like that. It's just a little bit of a different world, and a lot of very interesting cast of characters. We thought it would be fun to talk about today. So let's get into it. Griffin, how are we doing this week? Tired?
Yeah, tired. A couple things just popped into my mind.
Yeah.
I might have worn this pullover here on a previous episode. I need to expand my wardrobe if we're going to be doing this every week.
No, it's all right. Being consistent. No,
thing.
that's your uniform.
I just got a little nervous to look down. I was like, I'm wearing the same thing I wore maybe a couple weeks ago, but that's okay.
If we have folks that are going to start calling you out for wearing the same thing on previous episodes, we've got some real fans.
I own at least 3 of these, so it's all getting recycled.
It's clean.
I'm a little sleepy. There was a band called Slightly Stupid. Today I'm slightly sleepy. We got back, you mentioned early this morning from Miami. Was an awesome trip, obviously, to get out of the Indiana weather. When we landed last night, it was 14 degrees.
Yep.
So the sunshine and 75, 80 degrees in Miami was much appreciated. And then the hotel we were at, Spencer, was one of the nicest ones that I think we've been to in regards to the conference center. 39th floor, big floor-to-ceiling windows, great vantage point. If you're going to spend all day in a hotel in Miami, that was a good one to be in, but really had a good time walking around, shaking hands, meeting allocators, meeting other sponsors, other managers. The conversations are always positive, even if it's not an immediate direct connection in regards to raising capital for Midwest multifamily.
Yeah.
There's always some kind of educational component for me because there's so many different asset classes, risk profiles of wealth managers, anybody that's looking to allocate funds. They're always involved in something different. Like you said, it's a cast of characters. You really never know who you're going to meet or what kind of conversation you're going to have.
Yeah, and all over the international investors also. There was a lot of folks from Latin America, Central America, South America, folks from Europe. Like you said, those different perspectives doing some similar things, but then also very, very different at the same time. And just so really fascinating to see. Well, we're going to get into all that and more about capital raising, what's it like at these conferences. But first, let's jump into our latest research report. It's authored by our data analyst, John Chapman. Griffin put this together as well. My name's on it, but really those two guys put this thing together. An incredible amount of research, our own proprietary machine learning models. We're able to forecast rent growth, what it's going to look like in 2026, as well as vacancy and starts. Wanted to highlight one market. We highlighted Columbus last week. We're highlighting Chicago this week, which Chicago is not a market that Gray Capital we typically are actively targeting for. It's not one of the most landlord-friendly markets. Illinois isn't the most landlord-friendly state. There's a lot of political considerations, whether that's potential rent control, but also property tax liabilities, especially in Cook County. Some of the suburbs are much more attractive, but in our opinion from the beginning, there have just been markets with a little bit less risk and that looked appear as attractive, if not more attractive than Chicago or other markets in Illinois. So it's like, let's keep focusing, for us, at least for us, markets like Indianapolis, maybe a Fort Wayne, Columbus, Ohio, that are even closer to us and are more exciting than Chicago. But that being said, we're not the only ones that haven't been investing in Chicago. And the reality is that people haven't been building as much in Chicago. And so the fundamentals are really strong for a supply and demand perspective. And in our report, Chicago is projected to receive the highest rent growth of the markets that we analyzed in 2026, and it has been experiencing some of the strongest rent growth in the country, especially for a major metro. I think the only metro right now that is really beating it in year-over-year rent growth is San Francisco. But San Francisco had years of deep negative rent growth, where Chicago has been much more stable and has been compounding this growth. You have any thoughts on Chicago? I mean, it's close to Indianapolis, from the quality of the city, but also from a multifamily investment perspective. Curious your thoughts, Griffin.
Right. I think it's interesting. You see the positive rent growth story here. The really the leading driver in Midwest rent growth currently is Chicago. But as you mentioned previously, the barriers to entry relative to the state of Illinois, the city of Chicago, and its market. Are you willing to go through and kind of fight through, some of that red tape, jump through their hoops, incur, some of the legislative policies in regards to being a landlord, property owner, in order to kind of chase this positive rent growth story currently? There's obviously pockets and markets and counties upon which we're most interested, but it's quite interesting to see Chicago kind of surface in the back half of 25 as the leading market for rent growth in the Midwest. We love to go to Chicago. It offers, a lot of, to Midwesterners, a lot of this big city feel, the opportunity to go downtown, grab a nice dinner. The walkability of downtown is amazing. But in talking to a lot of my friends that live or are from Chicago, there seems to be a lot of interest in some of the suburban markets instead of the urban core. And so this 2% projected rent growth in 2026, while this is titled Chicago, Illinois, this rent growth projection does include, essentially the MSA, and so a lot of these suburban markets of Chicago, even into the state of Indiana, into the Decatur, or not Decatur, the Munster, Crown Point markets, to where I think there could be a lot of growth a little bit closer to Indianapolis and the great capital headquarters to get into and reap the benefits of the Chicago market.
That's a really good point. I'm glad you brought that up. And that is really kind of what we're more interested in. It's not necessarily on the Illinois side of the border, but some of the growth is spilled over on the Indiana side of the border and kind of the region, as they call it.
The region.
And I don't want to get into too much more details. I don't want to give away, some of our, true targets, but there are some markets up there in the region that are really attractive because, from whether it's an income tax perspective, just, political perspective, or just quality of life, there are folks that are, moving over to Indiana. And so we're seeing a lot of growth from the retail, jobs, and just population, just right in that northwest region of Indiana, a way to take advantage of some of the growth in Chicago without taking some of the maybe political or tax risk that might be present.
Just taking a look at the starts for Chicago, just quickly, as you see, we're projecting a 10% year-over-year variance or increase from 2025 and 2026. Maybe these 7,500 units that get delivered, that might be late 27, early 28, maybe even late 28. It's only 7,000 units in what is quite a large city. 7,000 units is quite a bit. What do you think this does? And I'm not asking you to project into 27 to 28, but this 2% rent growth in 26, based on the starts we're projecting, where do you think the rent growth story goes from here in Chicago?
I think it remains, relatively stable, and I think they're going to see some growth. I mean, even though the starts are picking up, again, their starts were relatively muted in the last couple of years. They didn't experience just that huge surge like most other markets in the country did see. So I think rent growth is going to stay pretty stable, and I think it's going to grow, as the rest of the nation grows, most likely in 2027. Just as a reminder on the report, one of the big takeaways is there's not the evidence and data to show that there's going to be robust rent growth. We think that's going to lead to some really interesting buying opportunities. So we think that the rent growth is probably going to occur, in 2027. That all being said, I could paint a variety of scenarios where we see rent growth stronger than this, not just in Chicago but other markets in 2026. So a lot of the week and we've really experienced some of the softest rental market I've really seen probably in a decade or so. This last 6 months. I mean, it's been slow. But so much of this, the two factors we talk about this a lot: are new supply and sentiment. Supply is moderating. We're going to talk about in the apartments.com list that I don't think it may be as dramatic as some people want it to be. It's not going to be all of a sudden there's no more new supply and everything's tightened up. It's going to be a gradual, slow burn. There's going to be concessions. There's going to be slow growth. There's just more competition in the market. Mm-hmm. But outside of that factor, the other piece is confidence in sentiment. And people don't want to make these large financial decisions with so much uncertainty. So if we can increase the certainty factor, I think we might be able to accelerate things a little bit. Then there's some other ancillary factors that, are really a dice roll. Mm-hmm. That people are going to be getting bigger tax refunds in 2026. That's exciting. What that impact is should be positive to rent growth, because technically it could be a little bit inflationary, but we'll see. Maybe people pay down their credit cards. They don't go and rent something. And just some of these other, kind of policy decisions, whether it's, deregulation, et cetera, does that really impact the economy in a positive way? I think it's a question mark. Some people think it will. Some people may think that it won't be noticeable. Sure. Tariffs, another, factor, more consistency in tariffs come off. You can paint, again, a variety of a number of, dominoes fall. You could see a chain reaction where we could see some really strong growth. I could paint a variety of pictures of where we don't see that growth, or things get really bad, and then you could even go to the extreme of even getting into a recession if the employment picture really the deterioration accelerates. Which we had a relatively weak jobs report this week, but it's not necessarily like the roof's falling off. Yeah. It's not great, but it's not absolutely the worst. So, but I mean, 2%. Annual average rent growth, again, historically, for any market that's a little weak, it's going to be below inflation. But when we're forecasting at the national level, 0.85% annual rent growth, you're more than doubling what that national average. So
correct, and shaving almost 200, if not more, basis points off of the vacancy.
Good point.
So there's obviously the suppliers remains low. In regard to the cross section of demand, and so that's where you're getting that rent growth.
Yeah.
Chicago it seems exciting for us across the next 12 calendar months.
Yeah.
It'd be fun to have those conversations with Addison and Jay in the acquisitions desk and see if there's anything that begins to pencil a little bit better for us in the Chicago market.
Yeah, we'll see. Stay tuned. And just as a reminder, December 16th, we're going to be doing that live webinar. We're going through every single Midwest market, getting into some of our strategies, just how we see 2026 unfolding. December 16th, it'll be a lot of fun. I think it's 2 p.m. John Chapman's going to be here. It'll be a great time. I want to go through this apartment list. They call it a white paper. I guess technically this is a white paper. It's an interesting piece that's perfect for this podcast and YouTube show. What's ahead for multifamily? 11 trends to watch in 2026. A lot of these things we've talked about, but not everything. A lot of this is kind of market-based. Some of this is operational-based, which we like talking about both. We've hinted about this topic today already, but number one, their takeaways for 2026 is the supply pipeline will see a dramatic slowdown. Saying after a record high wave of new supply in recent years, the construction pipeline will drop significantly in 2026. It's saying that it's dropped already 30% by the end of 2025. And permits are also on the decline, with construction starts having fallen 71% from a peak of 21,000 units in Q1 2022 to just over 60,000 units in Q3 2025. They do have this fancy chart here showing down, again, these starts coming down on a quarterly basis to only 60,000 units. Again, off from the peak of 200,000 units in 2022. We've talked about supply is going to be reducing for a long time. I mean, probably the last year or so, and that is true. But the more we've done research, our research, and the way that I guess we've seen it unfold, is that, and I think this is also the mistake. It's not even a mistake, but similar to the analysis on expiring loan maturities that we did a lot of analysis and research on as well. And while I think that we were pretty transparent that it's going to be a large window of max pressure, what it looked like in the perception that it created is that there's going to be an inflection point. So everyone is looking for like the moment that the market shifts.
Exactly. Yeah, you can't really, not clickbait, but it's definitely a better headline if you can pinpoint a certain month, a certain quarter where, hey, this is the trough, this is the bottom. Supply is dropping off that proverbial cliff that we talked about this weekend. That cliff might not be a cliff. Maybe it's just a constant gradual, downhill until we get to the plains.
Exactly.
Yeah.
It's just not, cliff is like literally it drops to zero all the way to the floor, and that's just not going to happen. And even this chart makes it look like it's going to like zero, which is just not the case. I mean, if you look at, we go back to even our analysis. We're forecasting that starts actually increase 7% from 2025. No, those are starts, aren't necessary deliveries. So that's a little bit of a discrepancy from the apartments.com, which is using CoStar figures. And this is obviously on a quarterly basis, and this is just at the end of 2025. But we're still going to be delivering essentially at 2019 delivery levels, which was at a peak at the time. And so it's a base effect and a relevancy of, it's off the peak of 2022, but we're basically back to 2019 levels. We're still adding a lot of new supply. Maybe it would be a very healthy amount of supply if we hadn't just delivered more apartments than we ever had over the last couple of years. But what we're getting at is for owners and investors who are anticipating immediate relief, don't get your hopes up.
Yes. There was it's great to see, a curtailing of supply. Obviously, it improves our fundamentals for, what we're talking about in our forecast is really the rent growth. There was an article that we included in the newsletter this week that was discussing the relative affordability for the median home in the United States. It took the least affordable markets, and then it took the most affordable markets. A lot of the markets that we operate in were in that most affordable markets category, and specifically, just out of personal interest, I had a heightened focus in Indianapolis. In 2020, there was almost 75 to 80% of the median, the homes could afford a median average household. Today, in 2025, it actually dropped below 50%, and that's in one of the most affordable markets in the United States. Half of our families, half of our households can actually afford to own a home. So supply is going down, and less people can actually afford to own it. You would like to think that the demand for rental housing relative to the supply will continually lead to, in our forward-looking years, 26, 27, 28, and beyond, positive for folks like Gray Capital and folks that want to invest in rental housing.
Yeah, I think it's a good point. And I mean, what was the statistics that we were looking at earlier? I mean, it's a $1,200 difference between renting,
the spread.
The spread between renting and owning. That's just your mortgage payment versus your rent payment. Obviously, doesn't include the down payment and the rest of it. All the capex, and if you're going to fix up your house, it's really expensive. No, that doesn't seem like that trend is reversing anytime soon. It doesn't look like there's a fallout in the housing market, at least just yet. We'll see if all the baby boomers decide to sell their houses all at the same time or not.
Right.
Not exactly counting on that either. Which markets will see the greatest decline in deliveries? This is back to the apartments.com report. Looks like Orlando, Florida is going to see quite a bit. Then Salt Lake City is going to be down. Austin, Texas down by 3%. Raleigh, Columbus, Ohio, Charlotte, Nashville, San Antonio, Phoenix, Denver. All markets need it. They need to see. Now, they have continued to deliver in a lot of these markets also. And frankly, they would probably need to see greater declines to really get back to positive growth. Austin, Texas has had negative rent growth for quite some time. Denver, Colorado has the most negative rent growth in the country of any major metros right now. All right, number two, we've been talking about this. Rent growth will slowly begin to accelerate again. They've tried to make this seem as positive as possible, and maybe so have we.
Right.
But this isn't really, too hot of a take,
No.
in terms of it's pretty tepid, if I have to be honest, because it's gonna begin. It's going to accelerate slowly. It's not necessarily going to grow a lot, but it's going to start to be positive slowly. How long? They're not sure, but they are saying in 2026 rent growth will finally begin to accelerate nationwide, but the increase will be gradual.
I hate to be nitpicky there, but what are your thoughts on the word usage or the choice for plateau? So how long did the plateau last? I think the last few weeks in the Gray Report we've talked about national rent going negative, and so it's actually beginning to have that down and to the right. So plateau for me would make it seem like rent growth is going to be relatively flat. And our projections, there is some slow growth, but it is relatively flat. And so it would just, for me, I don't mind the word plateau, but it just insinuates that flat rent growth will be flat across 26 is what they're insinuating.
I mean, well, the one credit to the plateau statement, because typically there's volatility, seasonality on rent growth. We don't have the apartment list piece here today, but if you looked at that, obviously there's usually a peak in kind of the spring and the summer. But as we talked about in previous episodes, that kind of seasonality chart has been flattening. And there's a little bit more growth earlier in the spring and a little bit more growth in the fourth quarter than we have seen in previous years. All this kind of brought on by the pandemic, shifting things around. I also think some dynamic pricing and being able to choose longer, shorter lease terms in more communities is probably impacting this. But we're seeing just a flatter curve of more consistent rent growth throughout the year. There are still peak months. This year moved a little earlier. It was more in March than it was in April and May, and so I don't know. Maybe it's not too inappropriate. They are projecting double what we're projecting, essentially for 2026, and maybe that's right. They have a kind of a kick up at the end of the year, and I think that's absolutely plausible. I think it could kick up to 3%. Again, if the things that we talked about earlier, consumers' sentiment. If tax refunds are really popular. If I don't know, something happens with tariffs, we don't get into a couple wars. I don't know.
Right.
People could start moving things around and get excited, get the housing market moving again. Certainly, it's possible, but they do seem to be a little bit more optimistic, or seeing. Yeah, there's a little maybe more optimistic than we are, or maybe we're also. I think that we've been anticipating return to growth for the last couple of years. And a lot of this is revolved around like interest rates. If interest rates are going to come down, transactions are going to pick up, and then thought it was going to be 24, I thought it was going to be in 2025, and now I think, and so maybe we're going. It's almost like I'm hoping that we're wrong.
Yeah,
it's like no growth. Market's going to be horrible next year. Prove me wrong.
Prove me wrong. We'd love to be wrong in that event.
Yeah, and I'm just looking at the data, just being straight up. But then also it's like, well, we thought it was going to be all better this year, a year ago, and so maybe we can do the inverse, will into existence by saying it's not going to happen.
Right. I think the ultimate key here is just being patient, sticking to your guns. As somebody that's looking to invest and or acquire.
Patience is key, and again, I think it's overall very healthy for the market. And if you're a long-term investor, this is all really good because there are going to be better entry points versus a scenario where things kind of kick back on and there was a lot of growth all of a sudden. There's be a rush in and could create another bubble potentially. This we're hoping for. That it creates an opportunity for some seller capitulation. Like we got to sell at a price where the market is, just because we don't have the time to wait another year to sell. Because everyone's been saying, well, let's wait for the market to get a little bit better. Let's wait to get a better trailing 12 financial statement to bring it to the broker. At some point, they're going to tap cry uncle, and they're going to say, let's just sell the thing. Just let me give you my money back. Let's redeploy it. And if you have a 2-year horizon, 3-year horizon, I think you're rolling the dice. It could pop off and make a ton of money. High risk equals high returns, but high returns equals a lot of risk also. Go to zero. But if you have a long-term perspective, I think 5 years or longer, I think you find yourself in the sweet spot. But it doesn't have to take 2 years or 3 years. It can be 4 or 5 years, but you'll have a strong basis and you'll be able to capture that growth. If you're not owning in the period of growth, if you're buying when things are growing like people were in 2022, maybe that this typically, these are long cycles, and again, it may not be the worst thing, but you're not going to make the most money. You're not going to get the most alpha in the market if you wait until the writing is all on the wall, because there is so much pent up capital that loves multifamily, just trying to make sense of the fundamentals. And so by just having that longer term perspective, being conservative, doing deals that work with, conservative assumptions, realistic assumptions, but conservative, you're not going to get burned and say like, all right, maybe this, I'm not super excited. This is just a 15 IRR, and maybe I could get more. I got more in the stock market last year, but maybe the stock market doesn't perform that well next year, and 15's not that bad. Maybe even 14, and then, well, maybe we don't sell it at a 6 cap like we're putting in our underwriting model right now. Maybe it does sell for a 5.5. Maybe things go back down to a 5 cap because AI brings in all this deflationary pressure and interest rates come down. Again, you can't underwrite that.
No.
But it's also not improbable.
You can't underwrite it. Maybe it just gets a little bit more speculative.
It does get a little bit speculative.
Maybe you shouldn't underwrite it like that.
It's cherry. That's why it's the cherry on top.
Yeah.
It's like you don't need the cherry. You don't even need the whipped cream. But
right.
If it happens, that's great.
This is interesting here that they've got the regional up close in regards to the markets. Chicago is on there right at that 3.4%. Again, they're a little bit more optimistic than our forecast, but look just right underneath Chicago.
Yeah, indeed. Yeah, they got it 3.2. I mean, we're about 1% on our forecast. So they're certainly a little bit more optimistic in all of their projections. Again, they've got Denver at 2.8. I think that's a tall order. Some of this, again, apartments.com, we talk about this sometimes, who is apartments.com's customers? Who are they selling to? They're selling to us. They're selling to apartment owners. Like, sure, they want you to rent an apartment, but that's not what this publication is for. This is for apartment owners, property managers, and they don't want them to be depressed because they want them to spend money on marketing through apartments.com. And so they're saying, don't give up hope. We want to fuel you with a little bit of optimism. I'm not trying to be too conspiracy theorists, but they have the industry in general doesn't love bad news. Now, there's sometimes where the data is what the data is, and you can't hide from it. But just having done our own research and our own models, this looks like the weights were kind of turned and pushed towards more of the growth perspective.
Right.
Which, again, there's factors that could lead to that. It's just you have to speculate a little bit more and really be optimistic.
Mm-hmm. I don't mind this forward-looking approach. We did our 2026 forecast, but I don't think that just looking out of your windshield does a whole lot of good if you don't have a rearview mirror and can kind of see where you've come from. Indianapolis year over year in 2025 we were positive, but Denver, to me that's a negative rent growth story in the last year, and so you're a positive 2.8% rent growth in 26, but you're coming from a negative year over year.
Yeah, I think they're like -8 right now.
And so then you want to take those 2 years, 25 and 26, put them together. What's the rent growth story there? You want to add in 24 and continue to kind of stack those years. And I love that Indianapolis is up here on their list because, again, in the Midwest, we've seen a deceleration in our rent growth, but we remain positive year over year. So just like we talk about compounding returns, we're compounding rent growth year over year to really drive NOI to then on the back end increase asset values.
No, it's a good point. It's that compounding growth and the consistent growth. San Francisco 4.2%, but again, I don't even know if they're back to 2019 levels.
Exactly. Yeah. So I guess if you just can't see the past year's performance, is it really 4.2% growth? I mean, you're within the 12-month calendar. Sure, absolutely. That's a positive news story, just like you're saying, that they want you to hold on to that optimism. But without better understanding what the last 2 years, the last 3 years, 5 years have looked like, you really can't get the full picture just from 1 year's data.
Yeah, really, really good point. Number 3, leasing and operations teams embrace automation, talk about unmanned communities, AI chatbots, self-guided tours, digital packaged lockers, self-service resident move-ins, and smart tech to reduce usage and detect leaks. This has been, I'd say, a trend before COVID, and then obviously COVID accelerated a lot of this, especially the self-guided tours. The AI chatbots have been around, but obviously AI is a much bigger story, and the AI chatbots that we're using today are just a whole different league than they were a couple of years ago. But But I think it's getting to the point of where a lot of apartment operators, especially at higher end luxury communities, A-class assets, you kind of need some of this stuff. The one that I think is controversial, and I can tell you what we think about, is the unmanned communities.
Yeah.
What do you think about it?
Well, so we were just down in Miami, and we're seeing all of these unmanned, whether it's vehicles, delivery, components. I think that and maybe it's because I'm a product of the Midwest, and
You see some of those clankers running around?
Yeah, I appreciate the interaction with a human being. Everybody does customer service, but not a lot of people do hospitality.
Yeah.
So I think at a gray residential, a gray capital property, there's some value in having the hospitality component where there's a friendly face coming, to your door to handle your maintenance request, outside of having this kind of vacant, empty space where you're ordering or establishing anything that you need, request communications on a tablet, a platform. You go to any restaurant these days and you want to order on the screen. I'd way rather interact with a human being personally, than send it through this unmanned property. But I do appreciate what it can do to overall expenses and in regards to cutting expenses and generating revenue on the back end. But I think one of the things that we're doing, and we've talked about previously, in regards to the centralization of our leasing and property management, just behind us here in the next room, we do still provide that human being touch, the hospitality component, to our leasing. While there may not be anybody always in the leasing office at our properties, several hours a week, certain days of the week, we do have folks that are there. But in the event that you need to call and talk to a human being, you can call, and you're always going to get Bronte, Brittany, anybody on the phone. And with our portfolio so close, we can send our leasing staff to the property. And so the vacant leasing office or the vacant community clubhouse, to me, kind of leaves somewhat of a bad taste in my mouth, but I do appreciate what it can do for bottom line revenue at a single asset or portfolio.
Yeah. I mean, you go to like a self-storage facility, and there's rarely anyone that's actually working at the self-storage facility.
Right.
I mean, there's right now, most semi-modern ones have a kiosk. You can go in, you can rent something just right there, as basically like a vending machine. And all that technology exists to do just about the same thing for apartments. And where I think it's important is you meeting the resident, the customer where they are, and that people have different preferences. There are some folks, might be Gen Z, it might be regardless of the generation, they might really like the idea of not talking to anybody and doing it all on their phone and doing a self-guided tour and moving themselves in. They don't have to talk to anybody, and that's, it's their prerogative. A lot of other people, though, I want to look somebody in the eye who's going to be around here.
Yeah, and that's my personality type.
Yeah.
I would way rather interact and engage, be able to ask questions in real time and get, authentic human being answers. You ever jump in an Uber and you check the box, not interested in having conversation?
I never check that box, even though I want to sometimes, because I
always feel bad if I ever do it.
I'm the same. You and I are alike in that way.
Because that person, maybe they want to talk.
Sometimes I do. I really wish I had checked the box, though.
Right, correct. But then, I've got buddies that live in markets where the Waymo is a big thing, similar to the self-storage facility that you were just talking about. If you're somebody that really has that preference of, I'm really not interested in having that human-to-human contact, there's options for that.
Yeah.
And I do think that we can provide a kind of a bifurcated solution and offering up, both avenues. And at the end of the day, there's an opportunity to, pair up software that allows folks to come through and really not have that human engagement. But if in the event there's somebody that does, we also have that optionality as well. And I think you can cut costs and provide a benefit to the asset, a benefit to our investors and your residents by offering them the optionality and kind of that all-inclusive package. I personally do not agree with walking into an empty leasing office and having it be fully automated. Yeah,
I totally agree. And that's why we're moving to having still folks in the leasing office, still having, a manned, leasing, or, community clubhouse, or maintenance facilities team are going to be on site. Maybe we don't have, large team of, leasing consultants on site. Maybe there's one, so the property manager, because there's going to be tours. We want to be able to guide you around if you want to come in and take a physical tour with someone.
Right.
Now, there's also opportunities where we might just be able to dispatch, somebody to give that tour that's scheduled. But what we believe is going to be a competitive advantage is being able to provide that human experience when no one else can provide that human experience. I think at some point there's going to be a little bit of a snapback and desire for human connection from some people, maybe not everybody. But what we've tried to do is look at what needs to be done on site, or what should be, what makes a really unique experience. But then what are the tasks that really don't need to be done on site? In fact, it's a distraction from the core responsibilities of being on site. Like a lot of administrative tasks. You don't have to do it there. The only reason to be on site is to make sure that the asset is secure. Kind of risk management. Keeping an eye on it. I mean, you think about we've got 60, 70, 80, $100 million assets. The idea of not having anybody there to watch it.
Right.
Is a little asinine.
It's a little bit unsettling.
Yeah, it's I mean, I couldn't talk to our investor. Do we have anybody at your company even, watching the asset? I mean, that would never happen because at a property that size, we have to have maintenance personnel on site every single day doing work orders, doing turns, and all that. But who's running the ship? There's got to be a captain driving the ship.
Right. I heard you mention this yesterday in discussion with an allocator in regards to identifying the daily responsibility of the site staff.
Yeah.
Maybe identifying that there are individuals that would otherwise work behind a desk in the leasing office, giving tours, running administrative duties, executing leases that we could bring here on site at Great Capital headquarters, removing an individual or two from our leasing offices, but then it also opens up an avenue or a window to bolster our maintenance staff. And so that way, if and when we do have a rush of maintenance requests, we're able to satisfy those requests in a timely fashion. We just have a higher capacity there. And in today's leasing environment, renewals are imperative to retain residents. Obviously, it's reducing turn costs, but we're also seeing a little bit larger rent growth on those renewals. So ensuring that those maintenance requests are taken care of in a timely fashion with a high level of not only customer service, but hospitality, resident retention goes up. So maybe that, you're solving two issues really at one time by reorchestrating and repositioning that site staff, one here on the corporate office, and then adding, a maintenance supervisor or a maintenance technician at each site.
Yeah. No, I'm all about it. And it's hard to do because it's hard to find the maintenance facilities that the folks that are really good to hire. But we want to I'd rather overhire in that area of the business. So one is protecting the asset. We're doing effective risk management, but also we're delivering the best resident experience, and we're not letting anything go and not getting the work orders on time. Because again, that's the reason why people decide to move. It's the number one reason. Right. Late work order, don't like it. We do have a comment. You can ask us comments in the chat, which is awesome. We'll get back to you. User WompWomp196 asks, human interaction is very important to the average consumer. I see reports talking about adding AI-powered leasing agents, and I don't think that people would prefer that over a real human. Yeah, we tend to agree. I think some people don't like dealing with people. I get it. And I think that if the technology does what you want it to do, there are cases where it's this is great, this is easy, schedule something for me real quick, let's get it done. But there's going to be a lot of cases where I just want to look to you face to face and talk to a real person.
Right.
All right.
I think too when you in our specific example here, the folks that we have that are answering the phones in our corporate centralized property management and leasing, they're well trained. They're patient, they're well-spoken. So when you get on a phone call like that, and even if your problem is, minuscule in your life, or maybe it's a big deal, when you talk to someone on the phone that has all of these, professional and personal traits that are positive, like Bronte and Brittany and the team we have here at Gray Residential, that customer experience is so far accelerated to just having that chatbot or that automated system of hit one, hit two, to get where you need to go.
Yeah.
It elevates that resident experience. So if there even is a thought of moving, it's hey, no, Gray Residential, they do a great job.
Yeah.
And if there's any problem, please call.
Yeah.
Because you're going to get this friendly voice on the end of the phone that is solution oriented.
Yeah. What we're really using AI chatbots or like virtual like receptionists. It's a part of like a layered system to be able to. It's kind of like a last line of defense, at least for us. It's not our front line. So like our front line is if you call us, we want you to get our absolute best, most effective salesperson. It's really selling. Not we're just going to lease you. We're not going to take an order from you, but our really highly trained leasing professionals. You're going to get our best person that's available, but they're not always available. We don't have a massive centralized leasing team.
Right.
We'll continue to grow it as necessary as we scale. But we also might be out of hours. We're not having folks work 24 hours a day. So like the second line of defense is we have a virtual assistant that's overseas. And this is for a lot of off hours, times that we're not going to be working, but someone that is trained, knows our properties. It's the same. They're essentially they're on our team.
Yeah.
You'll get to them next. But then whether it's in the daytime and our in Indianapolis corporate team isn't available to take the call, or if it's off hours, folks are busy, huge amount of volume, that's when the AI comes in. And you don't get to a voicemail. You still get to something that can effectively get you what you want.
Correct.
And maybe that is scheduling a call with a real person.
Right.
That's an option.
It's going to be really interesting as we get to number 4 here. AI-powered leasing will take off.
Yeah, well, and that's kind of what we've been talking about, right? Yeah, there's so much. There's so much opportunities for marketing and leasing in multifamily to use AI automation. Here's what we're dealing with, just again, lifting the Komodo a little bit, is that a lot of the traditional property management systems and software, they're not necessarily the quickest to adapt, and sometimes they can be relatively closed off systems, and they were already a little antiquated, but that was kind of fine for a while.
Yeah.
But it's not really fine anymore when new CRMs, new marketing systems are generations ahead of what kind of property management legacy systems can do.
Yeah.
But you're stuck in some of those systems, and so I think there's going to be some major disruptions in the kind of the prop tech space of a lot of new entrants. And then, for us, we're looking outside of kind of property technology and just looking at what's the best software and how can we adapt it to multifamily. It doesn't necessarily have to be that complicated. You don't have to get something that is absolutely custom built only for leasing multifamily properties.
Right.
Especially on the marketing and leasing side. But they say there's going to be a 26% increase in the use of AI-generated marketing, or there was, from 2024 to 2025. I mean, if you're kind of, to be honest, I mean, 2025, a lot of the marketing, you're kind of forced to use AI-generated marketing to some degree. I mean, if you've built a Google ad, I mean, like it basically starts by building the whole thing for you, and then you have to go through and say, no, that's not relevant at all. I'm going to fix that. And
this 26%, with the adoption of AI growing so quickly from 25 to 26, I would be very curious to see what that number jumps to.
I was going to say 2026, I guess it's increase of use. I guess I'd have to know what the previous use was, if it was already a lot, and what the adoption rate is. But that 26% isn't necessarily that much. I guess it is a growth rate rather than like an overall adoption rate.
I just feel like from 25 to 26, I mean, my grandma's using ChatGPT now, but in 2024 she wasn't. So I just feel like this number is probably increasing year over year, and it will continue to do so.
I agree. Yeah, no, my dad,
Yep.
stepmom are using it all the time, a little bit too much. That's a little bit too, but it is great. There are some good things about it. The Thanksgiving was interesting. We'll get into some of the questions we talked about. The leasing centralization trend will accelerate. This has been a trend for the last couple of years. At NMHC last year, in January of 25, a lot of the conversation was about centralization. A lot of folks have been moving towards it. Everyone has been doing a little bit differently. Centralization can mean a lot of different things to a lot of different organizations and different property management companies. I think there's going to be some more best practices that'll consolidate, through 2026. I think that makes a lot of sense. Again, establishing a centralized leasing office for multiple properties. Check, we've done that. Handling the lease process. Thinking that the application, the screening, lease, key handoff, etc. That's what's going to be happening at the centralized office, and then you can do more. And then there's podding, which is essentially kind of sharing resources between several different properties and kind of having like some specialists kind of oversee an area. And we've done a lot of that as well at Gray Residential over the last couple of years. But a lot of folk, regionally, it's different. I've seen in some areas centralization move much quicker and be pretty standard. But here in the Midwest, it's a little bit slower. We're not the absolute first. We've been working on it for the last couple of years, but we really, in 2025 was the year we really kind of kicked things off and accelerated it. A couple other companies did as well, but some other companies were doing it last year.
It seems interesting. Out on the East Coast, the markets are a little bit more tightly squeezed in regards to just surface area of land, and the Midwest we start to space out, and you get in the West, and again you get a little bit more space in between your markets. So, be curious to kind of. You probably would never be able to discover this, but the operators that operate on the East Coast versus folks that are Midwest and out West, who's using that centralized leasing strategy. Maybe the most. I feel like the East Coast would be a lot easier to achieve.
Yeah. Well, but it's a good point and a good topic of, again, what centralization means is different to other different folks.
Right.
Because, centralizing your maintenance facilities or podding of maintenance and facilities, that has more geographic constraints. It's harder if you're out in like the Mountain West and you've got hours of travel time between markets.
Yeah.
That's really challenging to do. If you're in New York, New Jersey, or somewhere much more urban on the East Coast, much more feasible to do. If you've got your pod like in one market, you can do it. But then leasing, other than needing someone to actually give a tour, which can be, you can schedule with if there's somebody on site, the centralized leasing team does all of the initial calls, goes through the screening, goes through the application, can tell them about the property, schedule the tour, and schedule it with someone that's on site. The centralized team they can be anywhere. They don't necessarily need to be in geographic proximity.
Right.
Sometimes it can be handy for them to be in somewhat close proximity. But again, it all depends on what you mean by centralization.
Right. That's a good point.
Concessions. Oh, we didn't cover this one. Transparent pricing will be the new standard. It's, what are all the fees you're charging me? What's utilities? What's my application fee? Tell me about my trash fee. Tell me about my pet fee. Who doesn't want people to know about this? So I think this is going to be true. Now, there's some states that are mandating this. We don't like states to mandate it necessarily. We've been talking a lot about some all-in pricing as well, which seems risky because we're going to include all of your fees. We're not going to. It's all just wrapped in. You get one number. The con is, again, someone doesn't do their due diligence and they see we're charging $2,000 and the guy across the street's charging, $1,950. It's like, well, the $1,950 is cheaper. It's like, well, no, it's $1,950 plus all these fees. It actually ends up being $1,300 versus the all-in $1,200 right here. Once the market is educated or the prospect is educated, they're like, we love it. It's all included. This is wonderful, but you have to get them to the point to educate them.
Yeah.
That can be the challenge. The other, I think it's way more of a positive than a negative, but why people might not want to do like all-in pricing or transparent pricing is then people, they can't afford it all of a sudden if they know everything, all the costs, which I think they need to know what they're going to be paying for.
Yeah.
But when individuals are screened for an apartment, they're screened for the rent. They're not, when they go through to see if you qualify from an income standpoint, your income versus what the rent. It's not rent plus utilities plus fees. Mm-hmm. What can end up happening is then it's like, you qualify barely on your rent, but then what you're going to be paying, you can't qualify. You can't afford it. And then all of a sudden you're delinquent, you can't pay your rent, and then you get an eviction, and that is horrible for everybody.
Horrible.
We don't want to. You don't want to evict anybody.
No.
It's expensive. You don't want to put anybody out on the street. You don't want to ding somebody's credit. Going through an eviction is horrible. It's a horrible outcome. Mm-hmm. So you want to do everything you can to avoid those outcomes. You want to increase your tenant profile, and so by doing that, it's harder to get it in. Your standards are a little bit higher because you're going to run their income versus the actual monthly the full boat,
Right.
you're going to get a tenant base that can actually pay the rent and increase your collections.
You go to a restaurant, you have a dinner, they bring you a tab, you have a total for your food and beverage, they add on some taxes, some fees, and then there's gratuity at the very end. It says total. I think that there's a way to do this in a very tasteful way that you might run into some confusion right away, but especially as we go to market our units on the internet, providing a monthly rental price, but with an all-in price, and then really describing what that all-in price includes.
Yeah.
Could be the best way. But I remember buying my first car, and it came fully loaded with Sirius XM radio. That was when Sirius was like kind of a big deal.
Yeah.
I bought it. You got the 30-day trial, but I didn't know it was a trial, and they want you to pay, let's just call it $120 a year to maintain that Sirius XM.
Yeah, now you're stuck. You're used to it at that point.
Well, and then guess what I didn't do, because I was like, well, I didn't have to pay $120 for this Sirius XM. So now I bought this car because it had Sirius XM radio, but I'm not actually using the Sirius XM radio. So
that's why you bought it
It's
originally.
similar to this. Well, it was
one
like
of the factors. It was a cool.
All the cars had Sirius XM radio,
Yeah,
but I was excited about it. So you rent an apartment, and all of a sudden you're finding out you have all these other associated fees. And again, maybe you can or can't afford it. I think it's a nice transparency of, hey, here's what you're going to be paying for rent, but our all-in price for the month is likely to be this.
Yeah.
And that all-in price can kind of move and shake just depending on, the year, I guess, and similar to rent. But I think it's nice to have some kind of idea of, at the end of the month, how much money are you actually going to be putting down to live in this unit.
Yeah. I mean, what's the alternative? Is like, let's just trick people into paying one thing, but it's actually more than what they think they're going to be paying.
Right.
What a bad way to start a relationship with the customer.
Right. So my car payment went from, let's just call it $500 to $620. Well, I like the $500 a whole lot better.
Yeah.
But if you would have told me it was $620, I can have XM radio all year, you bet it.
It's all about managing expectations.
Yeah, correct.
100%. Okay, we're going to move through this. Concessions will remain elevated. I think that's going to be the case. Again, we've got a lot of supply that has been delivered. We're still going to have supply that's delivered, and it takes a while for these things to burn off, and then you're going to be renewing folks, and they're going to be renewing without a concession. Maybe you don't want them to move out. You're going to have to probably give them another concession. Again, depending on where the market is, sentiment.
Right.
This could change. Maybe we won't need them anymore, but we're gonna, until things turn around, we're going to see more concessions. 2/3 of renters say they would be enticed by discounted rent.
Who answers no to that?
Who answers no? Someone who is saying, no, I don't like taking surveys.
Right.
Discounted rent for 12 months. Everybody likes that. If you rent for 1 month, people still like that. It's amazing the drop off in anything other than cheaper rent. Prepaid gift card that can be used anywhere. Like,
right.
It was popular for a while. Like $1,000 gift card, $1,000 Amazon card, and honestly, the industry was like, that's the best. Like, oh my, we're giving away $1,000 Amazon cards because for some reason, saying $1,000, it's almost like cash. Go spend on Amazon.
Yeah.
That seems really exciting, but they really want the money. They want it off rent. They don't want to buy like a toaster or something. They don't want to pay in rent.
They just want a deal.
Yeah.
They just want to be cut a deal. They want to feel like they're getting a better deal than what
they're not
would get
here for the
otherwise.
complimentary iPad. They're not here for that. Mm-hmm. They're not here for the gym. They're not here for any of that. They're here for I'm here to rent an apartment, and if you can make me a deal on the apartment.
Right.
So that's something to really keep in mind, because the reason why some people do a gift card is all of a sudden they can drop that into their marketing GL.
Right.
So it's not going to show a discount on their rent.
It's also interesting that the 5% variance between the 12 months versus 1 month. If I take your 1 month discount and spread it out across those 12 months, 5% more people would be more excited about that, but it might equal the same dollar amount.
Yeah, and I wonder if the discount wasn't as the total discount wasn't as great over the 12 months, if people would still prefer that.
Right.
But that's a dramatic fall off. It's good to know.
It is.
Resident retention will take an increased importance for properties at the top price point. Absolutely, we just lease up these properties. You want to keep them. There are options. People are going to be hunting for concessions. They had concessions last year. Are there still some in the market? People have been pretty defensive this year. They're going to be continuing to be defensive next year. Makes a lot of sense. It says vacancy will remain high even as new supply drops. Tend to agree.
I think this just shows the power of resident retention. Just making sure that the folks that are already in your units remain in your units.
Yeah. Especially when you're getting some decent rent growth on those renewals.
Right.
And maybe you're not going to have the pricing power to continue to push those renewals. But, I mean, not having to turn a unit that's huge savings. It's not necessarily cheap to turn a unit.
Right.
And to have, add in the time it takes, the downtime versus the materials, the labor, taking up time. Rather just renew you. Okay, 9. High-end properties will explore unique amenities to stand out. Absolutely true. We've had part of our business plans adding some, unique amenities or more amenities. Let's see what some of the unique amenities they're talking about. On-site cafe. Our coffee stations are always so popular. Residents love coming in and getting some free coffee. Now, I don't know if they're talking about a cafe as in actually you're going to pay for the coffee, or if it's just really fancy. But we've been working on a coffee program to really have it curated, and in 2026 we're going to have really, really good coffee at all of our properties. Not just it's we've inherited a lot of coffee machines and stuff like that. We're going to have really good coffee.
That sounds awesome. I'm looking at these amenities here, and we're down in Miami, as you mentioned previously in the episode, staying at a hotel that offered a lot of these amenities. It was a very pleasant hotel to stay in. I'm just taking a look at these, and if somebody was going to, it's almost buying one of the residences at this hotel that we're staying at. You're getting all of these amazing amenities: the sauna, the plunge pool, this recording studio, fitness space, meditation room. These are all things that who wouldn't want access to these, I guess is what I'm saying. It seems like we're creating these dream communities at a price point that is relatively amazingly affordable in regards to buying and owning a home.
The question that I always ask is, what moves the needle? What do people actually care about? And then there's the things that are good leasing tools, but then no one actually uses.
Right.
And that's okay, but in a more ideal world, you'd have an amenity that gets people to sign the lease, but then they actually use, and it has some good utility to the property. The one thing that, and I'm all about it in my own life, is the cold plunge, the plunge pool. Maybe if it's physically kind of built in, but I don't know about what the maintenance is on the plunge pool, who's cleaning the cold plunge, depending on what kind you're or are you buying how expensive of a cold plunge pool are you buying? How long is that going to be in working order? That's how many people are actually going to be using the cold plunge? Sauna, I think sauna is not necessarily new. We own multiple properties that have saunas. It was really popular to do in the 80s. Now you can get an infrared sauna much cheaper. When they break, it's something else to fix. Ongoing costs, but I love the sauna. And they're becoming, I think, more popular with folks. Same thing with the cold plunge.
A lot of these, to me, and especially just in the markets that we operate in, Spencer, where if you go down to Dallas or we're in Miami, some of these are these A-class assets that maybe these are the expectations. In Indianapolis and Columbus, these are not amenities that we commonly find in the Midwest markets. But I'm thinking in more of a strategic manner here. You see a lot of these mixed-use developments with multifamily, atop the the retail, and there's all of these health clubs, saunas, cold plunges, yoga studios, cafes down below. There's got to be a way, in our markets to develop partnerships with some of these, let's just call them fitness gyms, sauna studios, to where if you sign a lease at X asset, you've got a discounted membership at the sauna studio across the street. And or you get 2 uses each week. Something like that, where there's some kind of partnership that increases overall marketing capacity at the asset, but also might drive revenue to the sauna.
Yeah, good point. We do have a podcast room in one of our down at Echo Park in Bloomington.
We do.
Meditation room or pod. Can you meditate in your room? I know what they mean, but the VR room.
It seems a little.
Again, I didn't know you needed a special room unless you got real fancy setup, all the sensors and everything. Okay, moving on. Low and mid-price properties will maintain high resident retention. Yeah, agreed. If it's affordable, I mean, everybody's affordability, it's an issue. People are looking for a deal. If your rents are low, no duh.
Right.
11, unit-specific media will be a must-have. We have found this absolutely to be the point. We have put so much effort in getting videos of every single unit, every single property, so you can actually see that specific unit. No one wants to see a general just floor. I mean, you want to have like a map of the floor plan as part of your materials, because it's nice to see in that way. But then it's like, show me it, give me a tour. Right. I want to see that unit. I don't want to just see a model of a different floor plan. Mm-hmm. I want to see my unit. I want to see if the cabinets are all banged up or not.
It's the next best thing from being boots on the ground in the unit, taking a tour. And a lot of these, whether it's a family or an individual that's moving from market to market, it allows them it increases their chances of signing a lease from far away as opposed to just moving down the street.
Exactly. Okay. Well, that's all for the apartment list piece. Let's pivot for the last part of the podcast to talking about recent trip down to Miami, where we spent a whole day meeting with investors, other GPs, sponsors of all kinds of different kind of private alternative investments. So these are, on the GP side, other real estate folks, not just multifamily, but maybe it's cold storage, maybe it's self-storage, maybe it's data centers, healthcare, all kinds of different real estate. But then there's also private equity, people buying HVAC companies, people buying, medical practices, all kinds of different companies. And there's, the VC investors who are buying these early stage companies, folks that are, on the allocator side, or the GPs that are buying like secondaries or GP stakes, which are really interesting. Mm-hmm. Folks that are doing private credit to corporate credit, real estate credit, preferred equity, folks that are lending to cannabis companies, all kinds of interesting
tokenized
things.
Secondary markets.
Exactly. Really interesting. Some of it's esoteric, some of it's right down the middle, some of it is plain vanilla, and all in between. And then on the allocator side, I mean, you have family offices of every different stripe, from the multi-billion, you've seen their names in the headlines, to who the heck are you, to a lot of somebody's kid or nephew from the family office is sent to just learn about investing in general, and they're kind of they don't kind of fit in necessarily because they're not like as professional as everybody else, but they don't really care. They're not trying to sell anybody on anything. They're just there. Mm-hmm. But you've got private equity institutional allocators, pension funds, endowments, sophisticated family offices, just JV investors, and then just single family offices, folks that they're the guy, and they've had a huge sale, their family's had a huge sale of a business. Now they've got $1 billion or several $1 billion, and they're doing different things, and they're trying to find opportunities or see what's going on. Mm-hmm. I started going to these types of events really a lot back in 2019 before the pandemic. I've told you the story, Griffin. I've spent a whole year where I went to a couple of these every single month. And I learned so much about kind of the institutional investing world, how to sort of talk, or at least learn the jargon, and kind of just how that world worked. Because, I'm from Indiana, I didn't necessarily, work on Wall Street for a decade or at all. I spent some time on Wall Street, but not exactly in the same way that most folks would think. And so I learned a lot. I didn't necessarily raise a lot of money during 2019, so I didn't have really ton of deals to sell, and I was really just trying to learn. I was trying to make contacts. Then COVID happened. I didn't go to these conferences during COVID because they all canceled. They went virtual. And then I started going to them again. I was going to kind of one of the conferences for a while, but we've kind of gotten back into diversifying a little bit with different types of events that we go to. Just curious, you've been to a handful now over the last year and a half, 2 years.
Yeah.
What do you think the first time you went, and then what's it like now that you're not a newbie anymore? It's not your first rodeo, this last one.
Right. What a collection of people, what a collection of minds, and then more so a collection of how to put money to work. And I think when you go to these conference rooms and hotels, and you're milling about the room, and you're looking for, essentially that needle in a haystack. And, maybe you've seen the guest list, so you know who's there. It's out there. And so there's this kind of hunger to find that person, but you do have to navigate all of these conversations to finally get to, the allocator, the family office, somebody that has a general interest in what Great Capital is doing. But along the way, that journey to find that person or that group, I've had so many interesting discussions. And like you said just a minute ago, it's an incredible opportunity to learn about the different asset classes, about different ways that institutions, RIAs, family offices, high net worth individuals are all putting their money to work. And so in my process of being a part of these, large private markets, real estate, investment conferences, the most enjoyment that I've had is obviously making that connection, explaining to them, who we are, Great Capital, Indianapolis, Midwest multifamily, having them, kind of light up with, oh man, I've been waiting to meet you, but also having that same experience. And then once you have that really positive conversation, and when you get back to the office and everybody wants to know how the trip down to Miami was, it's really awesome to be able to deliver some positive news and just say, hey, I've got 4 or 5 business cards I can't wait to follow up on. But then navigating these conferences can be quite fatiguing. But it is really that those 5 or 6 interactions that you have, that you bring back to Indianapolis, back to Great Capital, that kind of is, illuminates your way and makes it interesting to then go to the next one.
Yeah. Because the one right connection that actually hits could change the trajectory of the business. It could change your individual life.
Right.
If you get in bed with, again, a multi-billionaire who wants to fund every single project, write the whole check. We'll write a $20-30 million check. We'll do 4 of those a year for the next 10 years. I mean, just that, and that doesn't just happen. You have to build a relationship over a long time. But just the opportunity is exciting. But again, that's way easier said than done.
Everybody's there, and everybody has a purpose. Right? So everybody that is there has a purpose. They're there for a reason. So as I'm interacting with these folks, whether they're an allocator, they're a sponsor, or a manager, following the introduction of, hey, I'm Griffin from Indianapolis, my immediate go-to is like, why did you come to Miami? Why did you come to this conference? What's your purpose here today? And oftentimes I'm looking to raise funds for whatever it is that they're investing into. But it's awesome to hear, I'm looking to place some capital. I'm looking to source some managers. And then from there, it's a really engaging conversation. And not that when you do meet another manager or a sponsor, does that conversation just die, but out of respect for everybody's time, everybody's understanding where they're looking for, synergies. And so when you identify that maybe there's not a whole lot of synergy there, there's this desire to kind of part ways quickly, I always simply just ask, do you mind telling me a little bit about your business so I can better understand it? And then typically showing just a little bit of interest. You never know what you're going to unearth. Maybe that individual invest in a multifamily himself, but that's not exactly why we're there. But I just think there's somewhat of the transactional component to these networking events. And I've noticed this in the past. It's a weird human habit that doesn't ever really happen in the real world, but inside these conference rooms, everybody will walk around and look down at your name tag. Nobody's really making eye contact. So and when we were just in Miami, I made it a kind of a personal challenge of mine I don't care what your name tag says. I'm just going to say hello to you. Ask good questions to unearth, what it is that your name tag would otherwise display that maybe I don't know. Great Capital, it's not very distinct in what we do. It's just obviously, we're maybe a private equity fund or a finance fund or a financial institution.
Yeah, Great Capital could be anything.
Right? So who cares what your name tag says? I'm rather just going to walk around and make eye contact, hopefully, and go over and introduce myself. But overall, I've really enjoyed going to these conferences, investment conferences,
summits, meetings, whatever they want to call
whatever
them.
they're called. We've been to Chicago, we've been to New York, we've been to Miami. There's all sorts all across the globe.
And
go ahead.
Well, and I would say, I think, just think about the naming of them. They're almost more better called like meet. Conference can kind of paints the picture that it's like a large event in a conference center, and these are how many people do you think were attending? Maybe 100.
I was going to say, if I said 150, would that be too much?
I feel like it almost is too much.
Okay.
It's somewhere between 100 and 150. 100 seems maybe like a little
It's oftentimes
light.
a little bit tough to tell because nobody's ever really in the same room.
Yeah, it's
There's
true.
three or four areas where everybody's kind of milling about. There's panels of discussions and topics to where if you're interested, you can go and sit down and listen. Spencer, you spoke on a panel that I thought was really engaging, get you in front of the crowd.
Yeah.
So not only do they now know that, oh, Spencer, you're Midwest multifamily, they recognize your face, they can kind of hear what you're doing. That's also a really good way to have people come up to you and because they're interested in what you're doing. And then there's, a networking or kind of coffee area. And then there's kind of this private table meeting room to where if you do have a meeting on the calendar, you can pull somebody aside one-on-one or group to group and have a little bit more of an intimate, prolonged, maybe longer duration conversation. So 150 is a good guess.
How do you start a conversation with someone? I think you're better at this
Right.
than I am. No one knows anybody. Everyone there is the network. But when I walk into some of these networking events, and it seems like everyone's already like paired up and they're talking to somebody.
Yeah.
And I never want to like butt into a conversation
Right.
or interrupt, even though that's what you're there to do, and
Yes.
someone else does it, and it's fine. You're really good at this.
Right.
What's your key? What's the strategy?
So I don't think there's a good or a bad way to do it. When I'm engaged with somebody, let's just say it's a one-on-one and there's a third party that comes up and says, hey, I don't want to interrupt. Well, you just did. So don't say that first of all, because it's like all of a sudden now you're like, well, I know you don't want to interrupt, but you did just interrupt. So I always walk up and I just ask, would it be okay if I introduce myself?
Yeah.
And everybody's going to say yes. And you say, hey, I'm Griffin, from Indianapolis. I'm here with my CEO, Spencer. We're out of a private equity multifamily shop in Indianapolis, Indiana, somewhere along the lines. And then they'll be like, oh, real estate. And then the conversation kind of goes from there. If you are walking up, it's such a strange feeling to walk up to 2, 3, 4, 5 people that are already, kind of in the conversation or a huddle.
They look like they're best friends.
Correct, but
they just met each other. They don't know each other. They might not even want to be talking to each other.
90% of the time, it's the first time they've ever interacted.
Yeah.
We saw some folks that we've seen in Chicago and New York, at some of these events, and
on the circuit.
You have on the circuit. You have a little bit more of a familiarity with them, but we've also met you before, and so we're probably less likely to spend any time, having prolonged conversation with
it's
you.
Either there's something happening
you're
or
a known
not.
quantity.
You didn't get back to us.
So when you do, you walk up to these. Let's just say there's 2 people. It's you and I talking to each other, and somebody else wants to walk up. That is a really challenging environment to enter into and to penetrate politely. But the best way I've seen it is you just kind of walk up. They're obviously in discussion, so you don't want to be like, hey, quit talking. But you kind of wait for somebody to finish, and then obviously you're standing right there, and so they kind of look at you, and you just say, hey, if it's okay, I'd just like to introduce myself, and they're never going to tell you no, because that's what everybody's there to do, is just meet people. And so you have to lose the fear that people are, one, not interested in meeting you, because that was, when we first went, I was like, well, why would anybody want to talk to me? I'm Griffin from Indianapolis. But at the end of the day, everybody's there to make new connections and interact with folks and learn and discover new opportunities to invest.
Yeah.
And so there's really nobody there that's going to be disinterested in at least meeting you, hearing your name, and what you do for work.
Yeah. Well, any interesting stories, any conversations, characters that really come to mind, either this last meeting or some of the past ones?
I think you mentioned, one of the more interesting personality types or individuals that come to these events is the larger, more well-capitalized family office, we'll just call them beneficiaries or sons or daughters, grandchildren that will come to these. And, we sat down at a table. It wasn't the heir to the family office, but it was a young professional of a family office that was new to the family office space. And oftentimes, if you get this young individual in a family office, whether that's more often than not, it's family, but it could also be somebody that's a new employee. They maybe don't necessarily know too much about the family office, or what the main allocation buckets are, or what their targets for 26 and 27 might be,
or anything about investing, or
but simply
finance.
They just have a lot of access to capital. And when we were in New York, there was one of these individuals that from the outside looking in had the aesthetic of maybe not being super familiar with what was happening, maybe kind of uncomfortable in the situation, but he actually was on one of the panels and was super articulate.
It's surprising.
That was actually really surprising. And so once he got off that panel, it was amazing. It was kind of a little bit distasteful, in my opinion, of how many people were like, I'm going to get in line to talk to you, because he just unveiled that he was indeed associated with the family office. I went to you and Blake. We kind of kept it I would say normal. We had a reasonable conversation, talked about, how everything's been going. And then I kind of hung back, I would say kind of kept it cool like a normal person would do. And as that individual was leaving the room, I just mentioned, hey, I really appreciated your perspective. We're a Midwest multifamily firm out of Indianapolis. We're kind of teetering on the fence in regards to some of the things you've been talking about. Would you have the opportunity to connect in the next, 6 months to discuss, what you just mentioned on stage more in depth, rather than taking, 100% of his attention and time right then and there. I got his cell phone number, which I thought was successful.
Yeah.
Rather than, hey, an email and a follow-up email, and that just, continues to go. But there's these, to answer your question, there's these descendants of family offices that are young, maybe not essentially in the know and maybe not a main decision maker, but when they show up, they answer questions and they're kind of all over the place. Don't know which way is up or down, left or right.
So, and again, this is not to stereotype too much, but
Right.
A lot of times those types of individuals can come off like not everything is adding up. Like they don't always say it first. They're representing a single family office. Sometimes they do. Might mention it, but they'll say, "Oh, but really, what I do is I'm working on this project and that project, and I've got this other project and another project over here, and I'm running this business, and this business, and things that like you can't do. You can't do all of those things,
Right?
And so it's like it's starting to not like it doesn't all add up, and it's not that they're making it all up. They are working on some of that, or they are passively invested in some of that, or their family is invested in some of that, or their family has these portfolio companies and they're just kind of listing the portfolio companies.
Right.
But it's like it seems like you've got a lot. It seems like you got a lot of free time.
Sure.
But you're also saying you're really, really busy, and you don't come off as necessarily like you're here, like you're working and you're professional. One way or the other. It just it doesn't seem like you rose through the ranks to get here.
Correct.
It seems like you were sent here.
The other, personality type or individual that kind of stands out to me at these events, and maybe it's because they're doing something that's like so unique and have like maybe like pioneered this new asset class. But in New York, it was primarily a real estate alternatives conference. This one in Miami was more just private markets. And so there was a lot of other managers of different asset classes. And it's the guy that's doing the, tokenized secondaries, cloud-based real estate allocation platform that operates with,
AI, blockchain, every buzzword,
all these
imaginable.
different things. And
Can't understand it.
when I ask him, like, well, so what's your
what does that
again?
do?
I want to learn about your business. Obviously, there's not enough time in today and what we're doing for me to really understand your business. But give me the 30-second spiel on why you're here, what's your purpose, and I'm lost and I'm totally clueless. And I'm thinking to myself, how many of these other people are here that are going to really have the time and interest to dive into this guy's asset class and that sector, to give him the time of day to be interested in what they're doing. And maybe that's not the case in point, like right there in the room. The point is to make the contact, show some general interest, and then set up a follow-up meeting in the weeks or months to come.
And find the one group that's like, we're looking
Right.
for something interesting to swing at the fences on.
There's a lot of that going on in Miami. Yesterday, and it was. It's never distasteful for me, and it's just always kind of like, what? Hold on a second, you're investing in what?
Yeah.
I think what we do, while it's not boring, it's very middle of the fairway. It's very vanilla, and it's proven.
Yeah.
So when you have a room full of people that are doing some of these like one-off, very outlier investment strategies,
AI, nuclear energy,
right?
Yeah, all on the blockchain. Like we buy apartments.
It sounds
in the Midwest.
Yeah, some of the stuff they're doing sounds fictional, and it's like, well, maybe it was 3 years ago, but now it's a real thing. And so when I walk around and introduce myself, you can typically tell by the look on somebody's face of like, oh, thank goodness, I understand what you do.
Yeah.
Oh man.
Yeah, there I go. Multifamily. I can
Right.
talk about that.
Right.
Yeah.
Exactly.
I
So
love it. I hate it.
I think it's good because there's at conferences like that, there's a general understanding of our business model, and so it makes it very easy to jump in and out of conversations.
Yeah.
It also makes it very easy to tell when people are interested or disinterested.
Yeah. How do you get out of conversations that are wasting time?
Right. So the one yesterday, very clearly I stated, hey, I understand our times here is limited today, and there's not a whole lot of potential synergy between our groups. I really appreciate you educating me a little bit on your business. I hope you the best of success today as you go about this room. and then it's over.
Yeah.
And you end that on a really respectful, positive note. And then, you're milling about the room again and you pass these people 2, 3, 4 times in the day. And I'm pretty good with faces, not very good with names. So the name tag is very helpful. But I know if I walk past somebody and I've already talked to you and it's like whether it did work or didn't work, I typically just kind of give you like a head nod. It's like, yeah, no need to bother you. There was a guy, I was kind of looking for you, and I was standing at a table. I grabbed a cup of coffee, and I did this to myself. I put myself kind of back against the wall, looking out at the room, trying to find you. And this gentleman came up and stood, facing me. He was selling life insurance policies. He called his business like the longevity investment business or something.
But buying life insurance policies.
Buying life insurance policies. And then he actually would sell them off in large tranches. But I got caught up in this conversation, and the only way that I could continue to kind of like deflect it was to keep asking him questions about his business and act interested. And finally, I just kind of ran out of questions, and I just said, hey, that's really great. There's really zero chance that we're going to work together. I really appreciate the opportunity to better understand what you're doing, but this is again, just don't want to just kind of walk away.
I think sometimes just being honest and being a little blunt and say, hey, that's really cool, but I need to keep circulating around the room because I'm here to raise.
You're not why I'm here.
We're here for the same reason. You're here to raise money.
Yeah.
And you can't raise. I'm not giving you any money. Sounds like a really interesting, whatever you do, but not making allocations. And I'm gonna try to circulate a little bit more and talk to a couple more people. Good luck.
Sure. And then there's the other side of the coin where you have a great conversation. Oh, Midwest multifamily, A and B class, vertically integrated. You guys are exactly what we've been looking for.
We should set up a meeting.
Holy cow, we found them.
Yeah.
You guys are it. And then you exchange business cards. Again, you walk past each other in the room a few more times. You get back to Indianapolis and you shoot off a couple emails over the next few weeks to months, and there's just nothing, no response, no reply. And so there's a part of these events that I don't know if it's just kind of like a posturing or an exercise of somewhat futility, but you meet these people and have all these really good conversations, but the action threshold for that next meeting seems to be really hard to get to.
Yeah.
And so I think one of the things that I could do better when we go there is to actually try and set that next meeting up while we're standing in front of them.
Yeah.
Let's go ahead and put a call on the calendar for a month from now, and if we need to move it, we can move it. I had an interaction. I didn't even tell you about this. I had an interaction with a guy. Was yesterday. He was an equity broker, placement agent, and he took out a QR code. And I scanned the QR code. It pulled up my email, my Gmail, so it was kind of like wasn't exactly perfect, but it had already pre-written out this email, and it said, "Hey, Spencer, really enjoyed meeting you at the Carmo conference. I'm vastly interested in your placement." Wrote this email, pre-written email, and it had essentially a, "Hey, please follow up with me, in the weeks to come to schedule a meeting." And it sent that email.
You send the email to him.
To him.
Yeah.
So when he got back, he had not only had my email address, but he also had that action item. I'm sure they've got it set up on the back end on some AI generated task, thing, where it's going to send me a calendar invite for a meeting in a month. And I was like, wow, that says now when you get back, one, we just missed a day and a half of work, so inbox is a little full. We're catching back up, but now I don't have to actually remember to send that contact an email in a month.
Yeah.
It's going to do it probably for him.
The follow-up is the key. Because you can have a great conversation, but, all these people have had a dozen or more conversations at that conference. So you have to stand out, and they're going to get a dozen plus more follow-up emails. Maybe some people forget, but they easily are ignored. And so you have to stand out of those at least a dozen amongst everything else they have going on in their life. And who did I have a conversation with? Are you the guy? Are you the AI blockchain guy, or are you the Midwest multifamily guy? I forget. Remind me.
I was throwing out business cards on my desk earlier today, trying to remember which business card went with which conversation.
Yeah,
it's not easy to do.
Classic tip is I always
make
old
a
school
note
on the business card.
Yeah.
Make the notes. Now, and we've seen the business cards come back. Post COVID, it's like no one had their business cards anymore. Now everyone's got business cards again.
Right.
But also a lot more of similar, like scan a QR code on my phone, or like, hey, type your email address in. I did. Hey, there are a couple. What's your Instagram? Like,
Yeah.
let's connect. Let's
Really?
connect on Instagram. Let's connect on LinkedIn. That way.
Very
In
cool.
addition to the business card. But yeah.
You've asked me about my experience at these events. I'd be curious as to yours. Maybe within the last 3 to 4 that we've been to, we've essentially paid to play. We've sponsored the event, so our logo.
Yeah.
is
This is not cheap necessarily to go to these events.
correct. So our logos are included in the pamphlet on tables, whatnot. But it also gives you an opportunity to get up on a panel. They give you a microphone, let you talk into a microphone. I think that's always good to be able to get Gray Capital out there in front of whatever group of people decides to listen to that panel. But every time you're on a panel, you come off that stage, there are people that are immediately walking up to you. Describe that experience. Like when people are approaching me, it's just to introduce themselves. It's never, I know exactly what you're doing. There's got to be a level of success that paying to play gets you in regards to those conversations, and not only the conversations, but the efficiency of those conversations, because you've already divulged what exactly is Gray Capital's doing.
Yeah, I mean, part of the sales process or what is establishing yourself as an expert, and there's nothing like doing that besides getting on stage and telling everyone what you know, and they can decide if you're an expert or not. And if they don't think you're an expert, they're not going to come and talk to you. But I mean, this last conference, as an example, I mean, I got off the stage, walked down, a guy approached me, and he was a multi-billionaire. And he loved what we do, and he told me that he's like, you're clearly the only actual operator that was on the stage, because what you were saying was actually real information. It wasn't just a sales pitch. And he's like, I'd love to talk to you. I'm working on this now. He's like, I'm working on this one project. Wanted to see if you could help me to kind of do this, but also like I'm totally interested in what you're doing. Now, a conversation like that, I've had so many of those, where it's like they've approached me, they said they were really interested, and then all of a sudden you follow up, and then it's like you can't get a hold of them.
Right.
And it's a real head scratcher. I mean, there's been some other cases where we've had, hung out for 2 hours with a group or with a guy, and like, absolutely, or at least we'll have a follow-up call, and you get completely ghosted. And that's just part of the process. And because you don't necessarily need dozens of these to work out. You really, the right partner can be a complete game changer. But we joke a lot. At the end of one of these, we would come back or talk to somebody on the phone the next day, and they're like, how'd it go? Did you raise some money? And every time I'm like, they didn't write us a check when we were there. Like, one, we don't have a deal right now. Yeah. But second, it's like they don't write the check right there.
Right.
I mean, they can say, all sounds great, but it's all, deal dependent or diligence dependent. And it's a process. It's the start of a process, and it's the opportunity to begin a relationship, because in that environment, it's still so transactional. We're just getting to know each other just a little bit, and then it's to be able to get that follow-up meeting to build the relationship. Right. And we have built some really meaningful relationships from these events in the past. But the converting is, I think, one of the biggest challenges, because you're in a sea of folks. They're going to talk to dozens of other people. They're going to like what they see. It's hard to put a face and a name, and everyone's busy, and to try to filter through, who's who. And so it's important to find ways to stand out, to get on the calendar.
Right. It's also, it feels like there's not, this is maybe not a fair statement, but you might not be talking to the main decision maker. And so you have to make sure that the conversation that you had with that individual, you've articulated the value of what we bring in our product and our investment strategies and our team to that person, so that when they do go back and they're having that conversation with the main decision maker, rehashing the conference experience, not only did they mention Gray Capital, but they're also able to articulate, exactly it is that what we do and why we would otherwise provide more value than somebody else investing in multifamily.
You kind of have to excite them in one way or the other. Like, hey, this is really exciting. I met this group, and this is why they really stand out. Right. If you're just add our name to the list.
Yes.
Good luck.
And then outside of going to these events put on by the the event curator, we had success. We had a successful meeting outside of the event when we were down in Miami as well. And I think that that's an avenue that I think can really unlock a lot of potential. Is just seeking meetings with allocators within the market that we're going to the event. And speaking of making people excited, we pulled out our 2026 multifamily market forecast and laid that on their conference table, just to show not only are we operating in these markets, but we're very data driven in these markets, and it's the decision making that we are implementing in our operations, in our property operations, in our acquisitions and dispositions. It's not just based on somebody else's research. We're doing our own research. And you talked about making people excited. I think when we got that out, put it on the table, and they flipped through it, it moved their needle in regards to
they were very
their perspective of us.
Yeah. Well, props to you and John for putting it together. It's a great piece. Griffin, this is exciting. We should do this more. Again, we don't want to give away all the secret sauce. But I also think that there's something about the way we do it that it's kind of hard to replicate. People have already tried. We have a lot of folks that try to do exactly what we do, and there's folks that do things way better than what we do. But I think what we do is pretty unique. So we should talk about this more. And let us know in the comments if you like kind of this inside baseball. How Gray Capital raises money. Sometimes, again, we always talk about multifamily and markets, but I find that, or I've had a lot of conversations with people that are interested and they want to know, where did your capital come from? And there's events like this. There's all types of different marketing and meetings and all different things that we do, things that we don't do, things that we could do, other strategies that people utilize. So if you like this type of content, let us know in the comments below. Just as a reminder, as Griffin mentioned, we do have this new Midwest Multifamily Report out. You can go to graycapitalllc.com, click the link, and you'll be able to download it. And when you do that, you'll be able to sign up for our webinar on December 16th at 2 p.m. Eastern. It's going to be an absolute blockbuster, and it's going to be exciting. So you can get the popcorn out, you can get the Diet Coke, and have a really good time learning about all these just exciting, thrilling Midwestern markets. Anything else, Griffin?
No, I've got zero.
All right. Thanks for watching the Great Report, everybody. See you next time.